Hello, my name is Benjamin Z. Miller, and in this presentation, I'm going to be talking about value investing for stocks. It is such an interesting topic. It's actually a very timely topic. As a matter of fact, Charlie Munger with Berkshire Hathaway, he passed away at 99 years old. Charlie Munger was Warren Buffett's right-hand man, his business partner. And Berkshire Hathaway is the most well-known value investing fund in the world. So we're going to talk about how that works and how that might be something for you to consider. So with the market price, this can vary from the intrinsic value of the company. And we'll talk about what actually determines the intrinsic value. There's a famous book written by Benjamin Graham, who was a professor at Columbia University. He wrote a book called The Intelligent Investor. And his student, Warren Buffett, studied with Benjamin Graham and really studied the book, was considered actually Graham's best student. But in this book, Benjamin Graham talks about the principles of value investing. They're not identical to what Warren Buffett uses at Berkshire Hathaway, but a lot of similarities. So Berkshire Hathaway, I like to use that as an example because it's the most well-known value investing firm. They are structured where they go and they purchase assets, but when they make a purchase, they're looking at what's the intrinsic value of the company. So they're not looking at it so much about trying to predict what's the price in the future is going to be. They're looking at what's the value of the enterprise, and they do that with a number of different methods. But the calculation of discounted cash flow is fundamental to value investing. And basically, you're going to take the cash flow of the firm or the company over a period of years. And there's a formula that's used where you can take the cash flow in year one, and then you're going to substitute in a value for R. R is the discount rate. And the discount rate, we'll talk about that, but let's imagine that you need to get a 10% rate of return on your money for it to be interesting. You would plug in 0.1. Or if you need to get a 15% rate of return, you'd plug in 0.15. And then you'd proceed with this formula. It actually can be done with a financial calculator, an Excel spreadsheet, or you frankly could do it by hand with paper and pen, just to go out a few years to get a general idea of what it might look like. So let's imagine that you're looking at a business and the discounted cash flow value is 100 million. So you perform this calculation and you get a discounted cash flow value of 100 million. Now let's imagine that on that value, that value for the discounted cash flow, you're going to divide it by the number of shares that are outstanding. So let's say there's 10 million, and that will give a value per share of 10. And then you would look at the asking price of the stock. And you'd compare what's the price of the stock to the value. So value investing for stocks, you're taking the value of the company and you're dividing it by the number of shares outstanding. That's basically how that is being done. You can do that for publicly traded firms. Of course, they have values that are in billions, not 100 million. You can do it in privately traded firms, and either way, the calculation is exactly the same. There's not a difference in how it's calculated. But once you have that value, then you're going to look at you're going to compare it to the stock price. And if you have a situation where the intrinsic value is significantly better than the price per share, then that's something that would be a good indication it might be worth buying. Or if you have a situation where it's the opposite, you may not want to buy that. But that's the concept of how it works with value investing. There's a few terms that you need to know about. There's authorized shares. These are the shares that when a corporation's first incorporated, how many shares were issued. So as an example, if they issued 2,000 shares, imagine it's a small little company, 2,000 shares. And then let's say that they issued 1,500 shares. and they put 100 shares in treasury stock, and they put 1,400 that were outstanding. Outstanding meaning that those shares are in the hands of shareholders. Those shares are in the hands of maybe some employees that have some ownership in the company, maybe some founder shares. And then there's some unissued shares. Well, when you do the calculation for determining the value, you want to take the outstanding shares. That's how you do it. You use that in the calculation. Another term that you sometimes hear is par value, and this is important if you're not familiar with it. Par value is when you first set up a corporation, it's a low value per share. And the reason that you set a low value per share is if you set a really high value, you could create a taxable basis. If you said that the shares are worth $100 or $500, this could potentially present a problem later when the tax calculation is involved. So it's best to set up a very low par value. As an example, we're looking at Facebook, and they used a par value of 0.000006, so quite a low par value there. If you use a par value that has even numbers, though, you end up with nicer numbers. So if you did, for example, 0.00001, and you're working on, say, 10 million shares, then you could get a value for those shares. If your startup issues 7 million shares with a 0.00001 par value, the minimum the founders would have to collectively pay for those shares would be $70. So it's something that's important, but it's important if you're forming a corporation to know about that, because if you make the mistake of setting a high par value, you may create a tax situation depending on where you're living. So you may have to go back and refile things. So you want to make sure you use a low par value. How do you value a privately held company? Once again, it's exactly the same as a public company when you are talking about cash flow valuations, discounted cash flow valuation. That method is the same. However, if we're talking about the way that publicly and privately held companies are valued, this can be different if you're not talking about a discounted cash flow valuation. There's other methods. One method is a multiple of EBITDA. EBITDA is the common metric that is used. That's fairly common in as a crude way of valuing things. It's something where you also will find that if you had two companies that had identical EBITDA and you were using that method of calculation, the publicly traded company typically is going to have a value that's twice as high compared to a privately held company, just by virtue of the fact that it's a public company, because a higher multiple can be associated. But none of that is relevant for value investing, because value investing, you're looking at enterprise value, discounted cash flow, and you're determining the value. So that's something that's important to know. So a famous quote from Benjamin Graham is that in the short run, the market is a voting machine, but in the long run, it is a weighing machine. So in terms of doing this, you would decide on a discount rate. Let's say you select 10%, you use 0.10 as a discount rate. Then you're going to go through the discounted cash flow valuation. You're going to get a value for the cash flow. Then you're going to divide by the shares outstanding, and that is how that is done. And it's something that's definitely worth knowing about. If you are seeing this on the internet, we have these meetings every week, and you can come to the meetings. It is fantastic. And if you have any questions about it, just let me know. Also, if you're watching this on the internet, you're thinking, that's interesting. I didn't know about that. I'd like to learn more. You should get in touch with me. I love to help people, and I'm available for mentoring. And then I also have some supplemental material that I can provide, some references, a copy of the book Security Analysis, which is the famous book Benjamin Graham wrote that Warren Buffett devoured. And then I also have a speech for Warren Buffett at Columbia Business School. Well, I'm going to go ahead and stop the recording now, and then if you're seeing this on the internet every week, we have a meeting. You are welcome to come.